All right, hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today I am absolutely buzzing to be able to finally talk more about a stock that I really, really like. I've owned it for quite a while. Okay, so disclosure. Today we're going to be talking about why Journey Energy may be one of my, if Meg is my favorite pick in the energy space, or in the oil space, then Journey is definitely my second. So thank you for watching, guys. Please feel free to like and subscribe to the channel. I've been very busy talking to some very smart people, trying to bring you the best content, which I'm able to. And if you're interested in copying the portfolio or following it, obviously I'll leave a link in the description on eToro, and we'll get straight into it. So macro overview, huge, guys, huge. It's all about oil. All right, it's all about oil at the moment. Basically, we've had the SPR releases scheduled to end at the end of October as I'm recording this now. I know that macro page says August. Sorry, that's a typo. This is October that I'm talking about. And the big news this week was OPEC Plus putting in place a floor essentially under the oil price. And this is a game changer because they have not relented to any of the pressure that has been placed upon them in order to increase production. Why would they? That's a topic we're going to get into a little bit later. But essentially, what this means is the only final doubt in people's minds around the world was, should a recession come, a really horrible, nasty recession, that will obviously increase the rate of demand growth for oil. And so that was leading to this narrative that oil prices were going to drop. And in fact, the paper and futures contracts did drop. Whether that reflected the physical market is another question, but you can read about that in another day. This is important news because it looks to imply a floor price of potentially $80 a barrel, WTI. And so now for me, although it is obviously oil is my biggest exposure, it's time to get some talk. And I'm going to talk you through one way that if you guys are not savvy with options necessarily, you may wish to look at. This is a disclaimer, of course, it's not advice, it's just what I am doing and sharing my thoughts with you. So you've been warned. You've got a few ways to play this rising oil price. You can go the quite aggressive way that myself, I know Cuppy and Trader Ferg Cullen, who've had on the channel, talk a lot about using calls and call spreads to take advantage of this volatility when a commodity of which you have a high opinion or a strong conviction is in backwardation. And so the prices for futures contracts on oil, for instance, at the moment are in what we call backwardation, meaning the prices for 2024, 2025 crude light sweet is lower than the current trading price. Okay, or the average expectation of the trading price at that time. So what you could do is purchase calls and call options on those futures, and that's got a hell of a lot of leverage, and it's a winner take all game. Okay, so if it doesn't hit the strike price, you lose all your money basically. I'm going to be putting out some information in the ROI club as to some options trades that I'm making. If you are more sort of middle of the road and you're looking for ways of getting leverage, and intelligent leverage to the rising oil prices, you would look to the producers. You would look to producers that have not hedged most or any ideally of their production so that they can fully participate in an anticipated high price environment. And one way that Josh has often spoken about, I've heard him speak about looking for large amounts of reserves on the commodity. In this case, we're talking oil with low decline rates, and that will allow management some flexibility so they can tap into more production should the prices start to increase. And that gives you this kind of call option. And Journey, I believe, is one of those that has access to this embedded talk where you don't have to go and borrow money. You don't have to use margin. You don't have to use options. It has an embedded type of leverage. And this is a good leverage, especially for non-professional investors, let's say, and it allows you to participate in the good part of the leverage without the dangerous part of the leverage. We've got Russian production loss eventually has to come offline at the end of this year. And the thing with that is it's not as if you can just flick a switch and it magically comes back on again. Let's say in a purely fantasized world that Russia, the war ends, sanctions end, and Russian production comes back online. But you have to be able to get the US or Western technicians into Russia to be able to work on the fields because they're really poorly managed. And so there are so many obstacles like that in the way of continuing to have Russian production come online. Before the war, the Russians were struggling to meet their quotas. Josh has spoken a lot about this. And so it's not simply a matter of, okay, the war ends and Russian crude comes back online the way it was. We're not going back to where it was, guys. Okay, not going to happen. Further evidence of this is that the US are talking with Venezuela. So apparently they're totally fine with all the atrocities that Maduro has committed. And yeah, without going down that rabbit hole, Putin is bad, but Maduro is now somehow good. Go figure. And then we have an imminent increase in demand in anticipation of the European manufacturing sector switching their inputs from gas through to oil. So instead of burning gas for the manufacturing and heating based energy, they're going to be switching to oil. So some crazy times ahead. That is going to add close to 800,000 barrels a day, potentially, of excess demand. So let's take a look at the numbers from OPEC. This has been taken from, full credit to Saad Khan from the Pale Blue Dot. I love reading his takes on things, and this just saves a lot of time. I think he does very high quality work. So do make sure you subscribe to his work. The USA essentially has just sold its SBR for no reason whatsoever. And the reason I say that is that all the oil has been sold, or not all the oil, excuse me, all the oil that has been sold out of the SPR. I'm not sure what the hell they were thinking really, but it was to dampen the price at the pump, ideally, in order to buy votes, really. And so now what has happened is OPEC have not appreciated this at all, because this is all the things that they've been accused of doing, of manipulating the prices, as cartels tend to do. And so they have said, well, why are we going to increase our production when you're deliberately trying to lower the price? It makes no sense for them. And so they have said to the US that they are not going to adhere to their pleas to pump more oil. They're actually going to cut production to ensure a kind of an equilibrium between the amount of production that all the individual nations listed here can produce at a price which gives them a decent margin enough to be able to fund their respective nations. Okay. So we're going to have a cut, and it's not the biggest cut in the world, but it's the message. It is the message saying OPEC is not going to do the bidding of the United States whenever the United States wants. And I mean, I think it's going to be a real game changer geopolitically. I guess it all remains to be seen. I've just put this simple scoreboard on here to update you all on the recent news. So we've lost production, as I said. Let's call it 780,000 barrel a day production cut from OPEC. We take the Russian crude offline by the end of the year. Let's say that's 1 million barrels a day, give or take. So there we lose production. Let's ignore the SPR for the moment, but the SPR eventually that has been selling millions of barrels onto the market will have to stop. The added demand from US gas to oil switching, Josh believes conservatively could be about 800,000 barrels a day. So we'll go with that. And then China, I mean, big question mark. When are they going to open? We don't know, but let's assume that eventually eventually 1 billion people are going to be sick of being locked down. So China is going to come back online. Aviation, transport, heat demand is going to come back online. And that can be anywhere, who knows, from 1 to 2 million barrels. So if we take the most conservative case, or the base case there, you've got this swing into essentially a drawing down of 3.58 million barrels per day expected, if all else is being equal. And of course, this is subject to change. What that means, to put that into context, is that we could see this idea of a recession. We could see a recession, the likes of the GFC, and still we'd start to hit equilibrium. Okay, so we are either going to have the worst recession depression of recent times, and we may do that, which will hold prices lower for a little bit longer, and then inevitably they'll have to start to come back up again. Or the demand supply ratio is not going to be nearly so bad as the bears think, and people are going to get a very, very, very rude shock on the upside when it comes to oil prices. I tend to lean towards the second view. However, I'm comfortable if taking a longer term view. If you're purchasing companies with good balance sheets, you should be able, and proper inventory, you should be able to ride out the inevitable volatility and take advantage of that over time. Same chart that I've shared last in my previous macro commentary. I can't believe this. This is the energy sector's weighting in terms of market cap of the S&P. So how much of the S&P pricing is from energy stocks. And if you look at the earnings, so that's roughly, call it 6% to round it up. The earnings are closer to 11 to 12%. So they're making all the money and no one's buying them. I mean, it's just ridiculous. Eventually, I do believe that will start to re-rate. See the interview on the podcast I did with Andy from Finding Value, and he goes into great detail in terms of how these ratios can look when they start to revert to their respective means. His SARDs, talking about crack spreads. I've put this here, and hopefully I've explained this well. So what we have here is the crude plus the crack spread, the refining margins, okay? So where people get a little bit confused is if they start to look at just the price of crude oil and they get a little panicky. We don't just put crude in our cars or put it into airplanes, but it needs to go through refinery. So you need to take into account crack spreads. What we have seen so far this year is that when we get to around about $180 of crude plus the crack spread, we saw some demand destruction earlier this year. What I've put in here in this black line down the bottom is a question mark. Is that going to be the OPEC put? And you'll notice that's around $95. So maybe if you've got a fairly conservative crack spread of $15 per barrel, and you've got WTI at $80, which we mentioned, it could be the OPEC floor. We would expect this number, okay, the front month futures of the crude plus the crack spread, to be at least 95 when that put starts to come in place. If it drops to that level, OPEC will start to draw to reduce their production. And then when we go back up to the top, when things are really starting to get red hot, then they may bring production on again. So this is an expected range, or I'm querying if this is an expected range in which we can see crude plus refined product over the next 3 to 5 to 7 years. Who knows? What I do know is within that range, the oil companies that I own are making an absolute ungodly amount of money. Okay. Here's my one pager on the specific company, and I did update the title here. So this is Journey Energy, okay? Trades on the TSX, which is probably another reason why people don't know much about it, because it's a smaller player, it's a smaller producer, and it's on a more obscure exchange. I like it because that means less people are interested in buying something that I'm interested in buying. So there you go. Revenue, using their quarterly numbers and doing a very, very rough extrapolation, we could see them come in at 225 mil. Big asterisk next to that. I'm less interested in that. I'm much more interested in their adjusted free funds flow, which management are putting in at around about $125 million. Okay, this is on a company with an enterprise value of $337 million. Okay, it's insanely cheap because it's been on a tear over the last few days. I believe my average entry price, I bought it for about 2 times the cash flows, the expected cash flows. I mean, it's just incredible. When you consider that it has a very low decline rate, so it's got very high quality wells, and it's got, at current stay flat production, we'll call it maybe 14 years of inventory. So I've bought 14 years worth of inventory for 2 years worth, let's call it 3 years. And getting the rest for free at maybe a 40 to 50% free cash flow yield. I mean, life is good in these type of scenarios. Enterprise value to free cash flow, currently that's yielding around 37%, depends on where the balance sheet ends at the end of the year. Oil prices could take off, and that could obviously shoot up to the upside. The mean multiple of what investors have been willing to pay for this kind of an asset is around 5x. And so, buying it at 2x, we don't even need to get a multiple expansion for me to do well on this investment. That's why I really like it. But again, as I mentioned, if you've got maybe 14-ish years worth of inventory, why wouldn't it be worth a 5x multiple? I mean, that's still extraordinarily conservative. Net debt looks like it'll exit net debt due to an acquisition that they made by the end of this year, but it won't take them very long at all. If they wanted to pay down that net debt, who knows, that could be zero by this time next year, quite easily, with them doing maybe some more acquisitions or potentially buying back some shares. But I think that they're looking at doing more of a roll-up which is interesting. Shares on issue, 59 mil. People were unhappy because they diluted their holdings a little bit in order to acquire assets being sold off by Enerplus, which is another company that I own. I believe this was one of the rare occasions where it was appropriate to dilute. I think they did a good job in terms of acquiring these assets. They will be accretive to their production, and it's okay to do that. It's okay if you're selling shares at a higher price and buying triple-digit IRRs within the first year. And that's what they've done with some of these assets and these wells. So I'm okay with that. I'm comfortable with Alex, the CEO, doing what he's doing. Of course, I like to be paid back early as an investor, but if it means increasing the inventory levels, if it means increasing the production to a degree, if we're coming into such a supply squeeze market, if it's an intelligent use of capital, which I believe it is, then I'm okay with it. Book value is what it is. This is all a cash flow play. Return on equity so far this year has been close to 72%. Yes, that changes a little bit because of the debt, but it's still fantastic in terms of the capital allocation. You can go back over the last few years and look at whether it's return on equity, return on assets, return on capital. The management have proved that they have come through the worst of it, and they have allocated capital quite intelligently. Their hedges are starting to roll off. They've only got about 20% of their production hedged. And if we are coming into this environment where we could see that $180 crude plus refined spreads, then this company is going to do very, very well, with the ability to fully participate in that, of course. This has just been taken straight from the quarterly reports. That production there, I believe, will be getting close. Yeah, we'll be getting close to 15,000 barrels equivalent a day as of the M&A work that they have done. And so the only thing really here, it's all pretty straightforward. I've seen some commentary that their corporate decline may actually be even lower than 12%. 12% is very, very good. That should command a premium valuation. And if you look at the recent acquisitions that Tamarack Valley did versus the acquisitions that Journey were able to do, Journey got these BOEs, these barrels of oil equivalent, for much, much cheaper price. And that doesn't make sense when they're such high quality, low decline wells. So again, I think Alex has done a very, very good job. Forecast free funds flow, as you can see there. Look, if you're paying $5.80 and you're getting anywhere from 2.23 to 2.34 FFO per share in the next year, as long as they can execute on that, that's my type of investment. Again, it's not advice, just what I'm doing. Here is a grid showing their sensitivity and how much torque they have to high prices. So this is the key for me mentioning torque earlier in the presentation. Across this sort of axis here, if you're looking at the WTI price, and then if you're looking at the Y variable here is AECO, which is the Canadian version of natural gas market. Natural gas is not a global market. Here, I'm very comfortable to use $90 WTI. I think we could be much more than that. But as you'll see, as we go higher up these prices for WTI, and 105 WTI plus even a $30 crack spread would be 135 on that previous chart that I showed you. So it'd be nowhere near where we were at the start of the year at 180. Okay, so these guys would be making a hell of a lot more money should we start to get into that type of environment. If things really do go crazy, they could be doubling the amount of funds from operations. So that's the beauty of not over hedging and being able to participate in bull markets when they come around. How much oil do they have left? That's the next question. So here we've got their reserves. Okay, so proved to be P1. Sometimes you might see P2, proved and probable, which is producing, and then proved, probable, and I forget the other one is P3. Okay, so proved, probable, and producing 22.6 million barrels. Okay, which is pretty damn good. And if you use a 10% discount rate, the MPV before tax is around 622. If you use that number, market cap is around 315 at the moment. So you're getting that net present value basically at half price. should all this play out, of course, and that's always the caveat. If they surprise on the upside in terms of some of the drilling, and we get to this P3 here, then you may be paying a third of their NPV. But obviously that remains to be seen from the drill results. Okay, crack spreads and crude versus Journey, and you can see, so 2020 obviously a bit of an anomaly. Before that, they're trading below the price of oil plus crack spreads, and the reason is mainly to do with the risk associated with the debt load they were carrying. Okay, they survived 2020, and now you've seen this crossover where Journey is actually outperforming the underlying commodity. That's the way that it should work. The reason is their very low debt to equity ratio that they have, so there's no more risk. So if what they sell is going through the roof, these guys are making a huge amount of profit, okay, at the raw commodity. And so you'll start to see, I would expect even a divergence moving forwards, where for every dollar, if you use this rough ratio here, for every dollar that oil plus a crack spread increases, these guys should be making $2, all said and done. So there's another good example of the talk. Now, why this particular company? Why not other companies in its respective sector, which would be Canada in North America? So let's take a look at the ratio, okay, that relative valuation that Andy likes to use. Journey versus XEG, and yes, I know Journey is a smaller cap company. I believe it will end up being a bigger cap company at some stage. But if you look at how many units you can buy of Journey versus buying the index, Journey is extremely cheap to the other assets in the XEG index. And so, you want to buy the least expensive house in the street, okay, in the best street. You don't want to buy the best house necessarily. And so this just shows that it's extremely undervalued versus its peers. And yet it has huge upside, huge torque, very, very good balance sheet, one of the best balance sheets there is, great management. They're doing a great job with accretive acquisitions. And I think that it's uniquely situated to do well. Given the price run up, the next question is, have I lost the opportunity? And that's just an anchoring bias. So if you look at just pure metrics in terms of valuation, not price, what you can see is if we go back before COVID, so January 2019, you would have been paying more for the company, okay? Even though the share price, okay, market cap was lower, you would have been paying more for every dollar of EBITDA that the company produces, okay? The net debt has come down, so they've done a fantastic job with the balance sheet, and they should be able to get rid of that, I would say, within a year if they really wanted to. And yes, they did dilute the shares a little bit, so you can see the share count bumping up there. But it was to buy really, really cheap oil fields. And so why would you not want to do that? Why would you not want to do that when we're going into such a hugely bullish market expected ahead, when you can diversify and increase your production and assets at a throwaway valuation? Of course, it makes sense to do that. And if you compare back to 2018, they're the same amount of shares outstanding for a much, much lower market cap, okay, so lower price of the company, and they had a lot more debt. So by those metrics, it's actually cheaper or better value today than it was back then, okay? Now, this is where things get a little crazy, and obviously this is just me putting out a scenario. What I've done here is I've used the discount rates slightly higher than the companies discounting their NPVs. I've used a 3 times multiple, the current share price, the fully diluted shares expected by the end of the year, and their current balance sheet metrics. Then I've taken the funds from operation expected this year, and I've said, what if they were to grow that at 5% over the next, call it 4 years? Okay, I don't believe that's a particularly outrageous suggestion, and so I've put it in here. Now, if this were to play out and we were to get an exit at that multiple, which again I think is absurdly cheap multiple, given they'd still have, if nothing else changed, probably at least 10 years worth of inventory, we'd be looking at a 3-bagger. So we've got a target share price of, let's call it $24 versus the current share price today. and that would be almost a triple digit IRR if it would happen over 4 years. Now, obviously, there's a hell of a lot that can and can't happen over that time frame. But this sort of thing, if you're willing to look outside the mainstream, for the right person, it might make a lot of sense. For me personally, again, I own it, so disclosure. Don't rush out and buy it just because I have it. You'll only be helping me. But I'm just sharing my thoughts on why I'm so interested in this type of company. If we paid the share price today and we got these expected cash flows, what I've done here is I've said that at 4 years out, they stopped growing their adjusted funds flow and they just held it at break even. Not break even, excuse me. They held it at the same amount for the next 5 years, and then they exited at that 3 multiple. Okay, so that's where I've got those numbers from. Obviously, you can use your own model and change that. If we discount it at the same discount rate that they've done their NPVs, we get an IRR of very close to 40%, which is phenomenal. In an inflationary environment, that might come down to around 21, 22%. That is the way to that I'm looking to protect and increase my net worth over this coming decade. Stagflation, inflation, horrible geopolitical events, who knows what the demand for oil is going to be there, and the opportunity to pick up producers such as Journey at this attractive valuation is too good an opportunity for me to pass up. And so I own the stock and I'm adding more to it in the story. So I hope you like that. The verdict obviously is that I'm long, in case you haven't figured it out. Levered to the oil price, different type of leverage. I own a lot of call spreads and all that sort of stuff, which if you join the IRR club, I'll show you exactly what I'm doing. Rapidly paying down the debt. They'll be debt-free very soon if they wish, or they can continue to add to their production capability. And you're getting it at roughly twice the cash flows with intelligent use of capital by the management. That's why I own it. That's why I like the stock. It's not a recommendation. It's just what I'm doing. But I hope that you got something out of that. I hope you enjoyed it. If you did, like and subscribe, because I look forward to hearing you. And the disclaimer again, guys, I'm not a financial advisor. I don't know anything about you. None of what you hear or see here is advice. It's just what I'm doing and me sharing my thoughts on my channel. You should get your own personal financial advice before you take any action on investments. And thanks for watching. Please do like and subscribe. I'm on Twitter if you want to hit me up on Twitter with questions. And if you're interested in following the portfolio, I'm making some more changes over the weekend. You can click on the link in the description and come along the journey. Thanks for watching, guys. Stay safe. I'll see you in the next video.